Gentlemen, good day and welcome to Eris Lifesciences Limited Q3FY23 earnings conference call. We have with us on the call today Mr. Amit Bakshi, Chairman and Managing Director, and Mr. V. Krishnakumar, Executive Director and Chief Operating Officer. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. V. Krishnakumar, Executive Director and Chief Operating Officer. Thank you, and over to you, sir.
Thank you. I am Krishna Kumar and I wish you all a very happy new year. Welcome to our earnings call for the third quarter of financial year 23. We've just announced the acquisition of 9 dermatology brands from Glenmark. This deal is in line with our stated intent of building a strong dermatology franchise. We kick-started this process with the acquisition of Oaknet in May 2002. The acquisition of the Glenmark brands will help consolidate our position further, especially in the antifungal and anti-psoriasis segments. The top 3 brands in the Glenmark portfolio, namely Onabet, Halovate and Sorvate, are ranked number 1 in their respective segments. 3 other brands from the portfolio, Demelan, Docetil and Aciret, are ranked among the top 3 in their respective segments. So 6 out of 9 brands in the portfolio occupy leadership positions. This portfolio has a revenue base of around rupees 85 crores. The purchase consideration is around rupees 340 crores. The deal will be financed through borrowings and we expect the transaction to achieve financial closure very soon. Post-deal, the contribution of dermatology therapy to our total revenue will increase from 7.6% to 12.7%. Our market share in the dermatology covered market will increase from 2.8% to 4.6%, and our dermatology market rank will improve from number 12 to number 6. The performance of Oaknet continues to reinforce our ability to create value through M&A. The growth momentum continues in quarter 3 with revenues of 60 rupees crore and an EBITDA margin of 27%. The 9-month revenue is rupees 183 crores, of which rupees 160 crores has accrued to Eris. The 9-month EBITDA margin of 24% represents an increase of 1400 basis points from the pre-deal EBITDA margin of 10%. As discussed on the last call, we are driving several value creation initiatives, including realignment of divisional focus with specific product portfolios and doctor specialties, expanding the bandwidth of the senior team, digitizing the promotional effort of the entire field force to enhance productivity, and expansion of dermatologist coverage from 60% to 90% in just 3 months post-deal. We also continue to drive the investment cycle in the business through the launch of strategic products such as Cosvate GM++, PhotoFirst, Dydrogestrone and FCM injection. Oaknet is on track to exceed an EBITDA of rupees 50 crores in financial year 23, which is 1 full year ahead of our expectation at the time of the deal announcement. Switching to the quarter 3 numbers as per AWACS, Eris delivered a growth of 14.7% in quarter 3 of this year versus a market growth of 11.6%. For the 9 months of financial year 23, Eris had delivered a growth of 14% versus the market growth of 8.8%. Our flagship cardiometabolic segment accounts for 54% of our revenue. Eris has registered a quarter 3 growth of 15% in this segment versus the market growth of 10%. In the last 6 quarters, Our cardiometabolic business has grown at a 15% CAGR compared to the market growth of 7%, which is a lead of 800 basis points. I'm happy to share with you that within the anti-diabetes segment, the new generation brands in our portfolio, namely the DPP-4 and SGLT2 segments, have registered a CAGR of nearly 50% over the last 3 years. These therapies will shape the evolution of diabetes treatment in India over the next 10 to 15 years. We have successfully leveraged our patient care platform and specialist engagement to build a significant early mover advantage in this segment. In December 22, these therapies accounted for 41% of our oral anti-diabetes revenue. This is nearly double of the 21% contribution we had in December 2019. This growth has been spearheaded firstly by Zomelis, our largest mother brand in this segment, which has crossed a MAT revenue of rupees 92 crores and maintains its number one rank among the generics. We've just crossed the third anniversary of the acquisition of Zomelis brand, and this brand has scaled up ninefold during this period. Gluxit, which is another important brand in this segment, has crossed a MAT revenue of rupees 51 crores, and it maintains its number two rank among the generics. Our combination products Zomelis D and Gluxit S, launched earlier this year, have taken off successfully with leadership positions in their respective segments. Secondly, our three emerging therapies, dermatology, CNS, and women's health, which collectively account for 21% of our total revenue, have achieved critical mass with combined annual revenue of rupees 436 crores as per AWACS. This portfolio has registered a growth of 15.7% in Q3 of this year versus a market growth of 12.2%. Over the last 6 quarters, this portfolio has registered a CAGR of 19.4% versus the market growth of 9.9%. This represents a lead of almost 1,000 basis points. Post the Glenmark brand's acquisition, the emerging therapies will have a combined revenue base of rupees 560 crores and will account for 25% of our revenue. We expect that Eris will continue growing ahead of the market by a significant margin on account of several growth drivers, including new launches in dermatology and cosmetology, strategic launches and consolidation in women's health, expansion of specialist coverage across the board, and current and potential inorganic opportunities. The VMN market, which accounts for 17% of our revenue, seems to have bounced back since Q2 with an average growth of 12.6% in the last 2 quarters after a prolonged period of extreme volatility following the first wave of the COVID pandemic in Q1 of last financial year. Eris's VMN portfolio has grown at 19.2% in Q3 versus the market growth of 12.6%. We hope that the VMN market will gradually stabilize and return to a secular growth mode. The key new products launched in Q3 include Xglar, which is our glargine offering, and Gluxit Trio, which is a combination of sitagliptin, dapagliflozin, and metformin. In the derma space, we have launched Cosvate GM++ and Photo First, an in-licensed brand for the treatment of vitiligo. Now coming to the financials. Our standalone operating revenue stood at rupees 332 crores for the quarter, which represents a growth of 9% year-on-year. The standalone operating revenue for the 9-month period of this financial year grew by 9% to rupees 1,016 crores. Our standalone gross margin in Q3 stood at 82.5% versus 82.8% during Q3 of last year. Our 9-month gross margin for FY23 stands at 81.5% versus 84% during the 9-month period of last year. So this is a difference of 260 basis points, which is largely due to the impact of new product launches in this financial year. In line with past experience, we expect that the margin profile of new products will improve as the products scale up. With the addition of 200 MRs at the start of the year, our employee expenses for Q3 have grown by 12.7% year-on-year, and for the 9-month period by 14.3%. Our standalone YPM in Q3 was rupees 5 lakhs. Standalone EBITDA for the quarter stood at rupees 126 crores. Our standalone EBITDA for the 9 months of this financial year stood at rupees 394 crores, which represents an EBITDA margin of 38.7%. Standalone net profit for the quarter stood at rupees 99.4 crores. Standalone net profit for the 9-month period stood at rupees 310 crores, which represents a margin of 30.5%. This includes Oaknet related impact on treasury income and finance cost. Our consolidated operating revenue for the quarter was rupees 423 crores, which represents a growth of 27.4% on the back of a 28% growth delivered in last quarter. The consolidated operating revenue for the 9 months ended December 22 grew by 23.2% to rupees 1,282 crores. Consolidated EBITDA for the quarter stood at rupees 137 crores, which represents a growth of 12.7%. Consolidated EBITDA for the 9-month period stood at rupees 418 crores, which represents an EBITDA margin of 32.6%. This EBITDA margin profile of 32.6% for the 9-month period is in line with our expectations, given that FY year 23 is a year of unprecedented investment, including the launch of our insulin business, amalgamation of the Oaknet acquisition, launch of significant new products across therapies, and commissioning of a new manufacturing facility in Gujarat. We expect our consolidated EBITDA margin to improve from next financial year onwards. Consolidated PAT for the quarter stood at rupees 100 crores. Consolidated profit after tax for 9 months stood at rupees 313 crores, which represents a margin of 24.4%. This is inclusive of all Oaknet related impact on depreciation, treasury income and finance cost. We are presently running trial batches at our Gujarat facility, and we expect to commence full-fledged commercial operations by March 2023. We expect to deliver a consolidated revenue growth of 25 to 26% and a consolidated EBITDA growth of 14 to 15% in this financial year. These were the highlights for the quarter. We are now happy to open up for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Kunal Dhamesha from Macquarie. Please go ahead.
Hi, thank you for taking my question. So the first on the revenue growth guidance, I think we were sticking to 30% till Q2, and with Q3 results, we have kind of lowered our expectation. While the Oaknet is doing better than expected, so what are the some of the pain points in our overall underlying base business which is not performing in line with our earlier expectations?
Yeah, so look, as we said, there has been a hit of around 250-300 basis points on the gross margins. That always happens when the products, when we have a lot of new launches, and which over a period of time gets corrected. Second has been 200 people addition in the overall things. Now, from a revenue point of view, there are only 2 moving parts. One is we missed on Zayo this year, which was around 30 crores last year because of reasons which are known. And then last year we had a 30 crore sale of Zandi, which was, launched during the second wave of COVID, and we did 30 crores in the last year, which we then discontinued. So we had a double whammy there. One, not selling that 30 crores this year, and also getting a lot of stock back. Though we haven't spoken about this earlier, but since you made a point, I just thought I'll tell you, if you remove these two parts, then I think, things look far better.
Can you just give me what would be the stock return impact till now for us?
It's in the range of 18 to 20 crores.
18 to 20 crores. Okay. For entire 9 months, first 9 months.
Yeah, correct.
Okay.
And also this is the return. And last year you see 30 crores have been the sales. So there have been no sales, and then there had been a return on top of that. The third, but not very, let me just complete one thing. It just came to my mind. Look, a lot of growth was dependent on the new product this year. A couple of new products got delayed by 2 to 3 months than what we expected because of the DCGI permission, which could have always happened. So we are still in the midst of a lot of launches in quarter 4 also, which we thought would be over by quarter 3. So there is some kind of a number which is coming from there. Otherwise, these two things are the major tangible, numbers.
Sure. Thank you. So basically, we sold 30 crore, but then it didn't sell in the end market, and that is what is coming back to us, right? Is the way to understand.
What happened here, when we were selling, now we actually reached 10 crores during the second wave, right? We thought that, even if it wanes down, we will be able to do 4-5 crores. But the positioning of the brand was so hard for, COVID, that, it didn't fly when COVID went.
Okay.
So we made our inventories thinking that at least 5 crores of the sale would retain. But, we were caught a little bit on surprise because of the positioning being so hard on that. And that point of time, it just went through the roof. Our prescription data, it was unprecedented for a new product to have those many prescriptions. So that was a big letdown. And then looking at what is happening in the market, we thought it is wise to take this hit because, it was going all over the place. And we didn't wanted the core business to get a little hampered by this. So we took a call on this, that once the positioning got so stuck to COVID, and second, we were finding it little wobbly for the rest of the year. So we said, okay, let's take this call and, get it back, get it off our shoulders.
Okay. And secondly, can you provide any update on our insulin franchise? What is the revenue for this quarter and EBITDA burn for this quarter or overall 9 months?
So 6 crores is the number for this quarter, which is a fair improvement from the last quarter. So this is how it is. We might end up this year by doing 23 crores of sale in the insulin franchise, and we will burn 20 crores in this year, 22 crores.
Yeah, and Kunal, the EBITDA burn in this quarter has come down to 4 crores, minus 4 crores that is.
From 6 to 4.
So 6 crores of top line and minus 4 crores of EBITDA.
Okay. Basically, the revenue has gone up, right?
Revenue has gone up, EBITDA burn has gone down. So that is the trajectory that, one had envisaged for the business.
Yeah. And Kunal, what happens, sir, because it is lying in a different, sub. That is why probably we'll take it as a new product or a new thing. Otherwise, we feel internally that's a part of the organic growth because, it was started ground up. Not very important, but just thought to tell you. So insulin is moving well. We did 6 crores. We expect between 7 to 8 crores in the last quarter, and going in the next year, we think this will be around 50 crores of, franchise.
Okay, perfect. Yeah, I'll join back the queue. Thank you.
Thank you.
Thank you. A reminder to participants to press star and 1 to ask a question. We have a question from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. So just on this brand acquisitions, so to start with, at least what would be the growth at which these brands have grown in the past, the ones which are acquired from Glenmark?
Tushar, there has been no growth in the past. In fact, there has been some kind of degrowth because these were brands, that were seen as non-core by them. That is the reason, you have that trajectory, but you don't have that kind of trajectory here.
So, so look, these are brands which in our view are substantially big brands. As we are sorry we uploaded the presentation very late because we were just stitching it up in the last moment. But once you go through the presentation, you would find that 6 out of 10, 9 brands which we are acquiring are in the top 3, 4 of that category. So these are very solid brands which have been, solidly built, I would say. The largest is Onabet, which is 30 crores, and then we have a HelloVet, which is 22 crores. So you will have to give us some time. I just told you, we'll just stitch it together. But we are hopeful that the way the energies which we see in Oaknet, plus on the side, I must tell you that during the last prescription audit, July, October, Oaknet had a 60% growth in prescription from dermatologists alone, which for Oaknet point of view was unprecedented. So we think this energy is going to, take this ahead. But to give you some kind of an idea, you have to give us some time to sit on the brands and, do that work. So maybe next call we will be able to give you a better picture. But the brand seems to be very impeccable as of now.
Got it, sir. At least this category at the industry level, what would be the growth to consider? Maybe Onabet as a category, HelloVet as a category, if at all. At the industry level, if not at a company level.
So Tushar, look, this is, we are strengthening our medical dermatology. You remember when Oaknet happened, we told you that we are very fond of medical dermatology because 70% of the patients do go to a dermatologist for medical dermatology. While cosmetology seems to be a lot, contemporary and a lot of fun. But the reality is that, these two, fungal infections, mixed infection and psoriasis, remain the major medical problems in dermatology. Now, if you look at these things, we are now in top 5 in both the fungal infection as well as the steroidal infections, the psoriasis market maybe. So these markets have traditionally grown by 9 to 10% all along. And, as usual, when you buy something new, you want that you should overgrow that.
Got it. And how much would be financed through borrowing out of 340 crores?
So we picked up the entire, number based on borrowings, Tushar. So the entire 340 crores is being funded through debt at this point.
And this is without GST, nothing?
Yeah.
Yeah.
And this would be at what rate? Cost of debt?
This is at around 8%.
Okay. And if you could, while I don't know if it is too early to ask, but so what kind of profitability or margins one should think about this business in a year or two?
So I think we need to come back to you as far as the year or two perspective is concerned. But what I can tell you is that every time we talk about M&A, we say that when we look at a portfolio, the gross margins are very important to us. So we never look at anything which is less than 70-75% gross margin. So this acquisition is also in line with that philosophy.
Yeah. The gross margins, I can tell you actually, the gross margins are upward of 78%.
Understood. And this one last one here, the manufacturing aspect and all of it would be all outsourced, right? And that should not be an issue like it has been in case of, let's say, insulin.
Yeah, at least that much we have checked, Tushar. So we have done that work. So there's no problem there, and we have bought enough stocks also to keep us going for a reasonable amount of time. And we have checked with everything. That is not going to be a problem.
Okay. And just one last clarification on a standalone basis with 9% year-on-year growth. So is it all to do with this Bragd and Zio? If you could throw some light on how Glimisave has performed.
Glimisave, I'll have to look at that individually. Will just help me with the data. But two important points, Tushar. I don't know whether presentation you've seen the presentation, but one point which KK made that the DPP4, which we were just 21% of that market, when the market itself was touching 43%. We have come a long way. So if you look at our major brands, we have come a long way. There has been these two disruptions which I spoke to you about. Beyond that, I don't find a problem. If you go through the market data, through and through the market data, looks good. And now, we are just looking at the possibilities. If we get Zayo back, which might happen. If that happens, then there could be some good gains coming from the cardiovascular side also. So that's the motto of thing. I can't think of anything which is very important otherwise. Glibic, I think Kriti will come back to you. But
sure.
At a
Mother brand level, you say 15% growth for the quarter.
Mother brand level, 15% growth.
Sure, sir. This helps. Thanks a lot.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have our next question. Give me a moment, please. We have our next question from the line of Tarun Shetty. Please go ahead.
Hi, sir, and thank you for the opportunity. I believe the Sacubitril Valsartan.
Sorry to interrupt. Can you use your headphones, please?
Can you hear me now?
Yes, please go ahead.
Yeah, sorry for that. So I believe the Sacubitril Valsartan category has largely genericized and many players have started launching. So will you be launching the same in the near term?
Man, you need to give us some time. There's a little bit of a tangle, we have a little bit of a tangle there. So, we just need some time. If everything goes well, of course, we will be launching, and we do have, I'm confident to tell you that we do have a history of the brand doing very well. In fact, if you want to get a little bit of detail, post our launch, almost 70% of the patients which were added to this therapy were added on our brand, so which is a good thing. So our brand presence have been quite good across through and through. So if we are able to launch it sooner, then I think we should be able to get much of it back and then plan the task. But you are right, it is genericalized. We will see that. But man, look, we are used to all this now. Tell me one product which doesn't fall like this. So we are used to 50 people launching in the first week and then climbing our way through. Our track record in diabetes and cardiovascular has been something which you could be confident about. Other than that, time will tell.
Okay, and we'll be following the same trajectory where we'll be partnering the initial launch and then we'll bring it to our own plan.
Yeah. That's most of the time that's the case.
Okay. And next on the MR side, with the new acquisition, are we looking to add more MRs or will be around the 3,000 level?
It's a little early. From an Eris point of view, we are well done. So we don't think Eris would be adding in the next year. Incrementally here and there will always happen, but nothing strategic. From an Oaknet point of view, we have to take a hard look. Prima facie, it looks that we may need to add people, and which will happen in the next financial year whenever it happens.
Okay. So, and just could you help me with the current MR count? Exact would be around 3,000?
What's the number?
2,225 in the standalone. 7?
So you're talking about the consolidated number?
Yeah.
Yeah, so consolidated will be in the vicinity of 3,000.
Okay, and standalone is 2,200.
That is right.
Okay. And lastly, just on the tax rate, could you help me with for any projections in current year and next 2 years?
Current year and next year will remain at similar levels, right? Effective tax rate will be at 9 to 10%. For financial year 25, we've already shared our guidance that because Guwahati is coming out of the whole arrangement and our Gujarat plant will be producing from March, but it will not be substantially scaled up. So financial year 25, we see a blended tax rate of around 27 to 28%. That is a book tax rate. We will still be paying cash tax at MAT. So what will happen is, we will start using the MAT credit, because by the end of financial year 24, we would have accumulated around 340 to 350 crores of MAT credit. So this will start getting utilized from FY25 onwards. So we believe that the cash tax rate from FY25 onwards will continue to be 17% for at least a period of 5 years. So FY25 to FY30, you will have a cash tax rate of 17%. The book tax will decline from 27% to around 17-18% during that period. So the long-term, stable tax rate, as I see it, will be around 17 to 18% once this transition is accomplished.
Okay. That's it from my side. Thank you.
Thank you.
Thank you. We have our next question from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, hi, good evening. Thank you for the opportunity. Just trying to understand, since we got into insulin and Oaknet, our EBITDA growth is lower than the top line growth, and PAT obviously much lower. So the first question is on the EBITDA growth. So since we are seeing the 3-4 quarters consolidating, and with this Glenmark asset coming in, is it fair to think that EBITDA growth should start showing better growth versus top line, or it should be in line going forward with the top line growth?
Yeah, Prakash, so I think we've been very transparent on this one. This year, the 32 to 33% EBITDA is what we have guided to, and that is where we are ending up. And as far as EBITDA margin is concerned, I think it's fair to say that it's kind of bottomed out, right? So next year onwards, we will see EBITDA margins improving. And that automatically implies that EBITDA growth will be better than top line growth.
Yes.
Can you repeat the last part?
What I said was that at 32.5 to kind of percent, EBITDA margins this year have bottomed out. So starting next year, we expect to see the EBITDA margins improve, which means that EBITDA growth will be faster than top line growth. Correct.
And what would be the levers for this EBITDA margin expansion going to starting fiscal 24?
Sorry, are you asking me what would be the drivers?
Yes, sir.
Okay. First and important driver is the insulin EBITDA, which is around minus 20 crores this year is what we expect. We expect to get to break even next year, right? So that is one important driver. The second important driver is Oaknet EBITDA margin has been consistently climbing over the course of the year, as you see. So next year, we are looking at a full year EBITDA margin of Oaknet, which will be very similar to what you see in quarter 3 or quarter 4. So that is the second driver. Third important driver is, obviously the acquisitions that we are talking about on this call. That has come at a very good gross margin, and we'll have to see how much field force we add there. So that math is still pending. We'll have to come back to you on that. But nonetheless, we believe that, it will be EBITDA margin accretive. And last but not the least, in the main business, as Amit mentioned, there are once this year passes by, the whole ZAGD effect goes away. Second is fingers crossed, but there is a reasonable probability that, we might start seeing something from Zayo. Third is the new products that are launched this year in Eris Lifesciences, they will scale up. So they will add to the top line, and then once they scale up, we will bring the products in-house, so they will add to the bottom line. So these are the most obvious things on the plate that will drive margin growth next year.
Correct.
Yeah, no, thanks for the elaborate answer. Just on the last part, so Eris key launches as of now, Zayo relaunch, what are these?
Sorry, Prakash, can you come again, please?
Which are the key brands launched this year, which can be, potentially winners for the next couple of years?
So Prakash, look, in the first year of launch, two parts. One is that the therapy gets adopted slowly, and then it increases the rate. Second is you don't get full year for all the launches. Sometimes it's 6 months, 8 months, 4 months, right? So top of the mind numbers which I could say we've launched Zomelis D, which this year would be like 17-18 crores. But it's like it has built up over. It started with 20 lakhs a month, and I think the last I saw was 1.9 crores. So going forward, all these multiplication will come. So I've seen Gluxit thrive in the same fashion, launched in September. Again launched at 20 lakh rupees a month now, showing 1.2 crores in the chart. So when you go to the next year, the consolidation happens both from adding up monthly sales and also by a full year effect. So these two things are going to add up.
Okay. And lastly, do we still see some portfolio or therapy gaps, or we are largely done to consolidate for the next 12 months?
In what sense you are asking? Because I didn't get you.
Which therapy are you referring to, Prakash?
Yeah. I meant across therapies, are we more or less done from the base business side in terms of acquisitions, or we see more gaps and more opportunities across therapies to acquire?
So Prakash, we've always maintained, you might hear more from us. So that will be, something which you will see in a sustainable way over the next years. So we maintain that though we have, in this year we have done Oaknet and we have done this deal now, but are we over? The answer is no.
Okay, perfect. This is very helpful. Thank you so much.
Thank you. We have our next question from the line of Kunal Dhamesha from Macquarie Group. Please go ahead.
Hi, thanks for the follow-up. So on the sacubitril valsartan combo, is the matter sub judice or something from that court, etc. is pending?
So Tushar, lesser you ask, better it is for us. What you said, Kunal, I'm sorry, Kunal, lesser you ask, better it is for us because it is still it's little which we can share with you. But I think by the time we meet up again on a call next time, we'll be able to give you complete color on this.
Okay, perfect. And in response to the last participant's question, we said that we are looking at Oaknet EBITDA margin, which is currently quarter 2, quarter 3 margin of Oaknet, or our overall margin can achieve in Oaknet as well.
I was talking about the Oaknet EBITDA margin for next year, and what I said is you've seen a quarter-on-quarter progression in terms of how Oaknet margin has progressed.
Mm-hmm.
So there was a question on what will be the drivers of EBITDA expansion next year. Yeah. So I listed that out as one of the drivers because Oaknet EBITDA margin for the next full year will be closer to what you see in quarter 3, quarter 4 for Oaknet.
Okay. And what is the quarter 3 margin for Oaknet? I think I missed that in the initial remark.
So the quarter 3 margin for Oaknet has been 27%.
27%. Perfect. And I think from the Gujarat plant perspective, I think last quarter we said the capex we were planning to do 180 crore, out of which we had done 150 crore. So is that complete now?
Yeah, the capex cycle is by and large done. So we have started taking trial batches, as I mentioned. And as we near to commercialization, there will be some more capex that will be expended. But by and large, the capex cycle is complete there. And I don't think you will see us investing in fixed assets for a long time.
Okay, perfect. And the last question on the new acquisition. So what kind of MR strength the acquisition comes with?
This is a pure brand acquisition, so there is no field force that we are taking from Glenmark, and there is no manufacturing facility or anything of that sort involved. So this is the kind of deal that we like to do, which comes with pure brands which have a good foundation and which we can take to the next level. As Amit mentioned, Oaknet, which is our vehicle for dermatology, will carry these brands. And what kind of field force addition we require in Oaknet for this and when do we require to do that? We'll have some color on that, when we've been able to spend 2 or 3 months with these brands, right? So by the time we come back to you again, we should be able to give you some color on this.
Okay, and what's the inventory that we have got in the 340 crore that we are seeing?
Yeah, give us some more time. Now. Though I have the answer, but it is really tentative, so I don't want to have head on this. I think we can offline tell you in a couple of days' time.
Okay, perfect. And on the new brands, you said EBITDA accretive. So would you be comfortable telling the time, whether it would be year 1, year 2?
No, in the first year itself, next year.
Okay. EBITDA margin accretive or EBITDA accretive?
EPS.
No, it is EBITDA accretive, right? Otherwise, why would we go and buy the brands? Because these are brands which have come at high GCs. Amit gave you a number of 78% plus, and then we have not taken field force, and there is no manufacturing, right? So it is obviously EBITDA accretive, and it will also be EBITDA margin accretive.
Okay. So EBITDA margin accretive means it would be higher EBITDA margin than our current margin, right?
So our starting point is a consolidated EBITDA margin of 32.6% for this year, right? So it is going to contribute on a journey for increasing that margin.
Perfect. Thank you so much.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. We have a question from the line of Niharika from Equitas Investment. Please go ahead.
Oh, hello. Yeah, hi. So my question is regarding Gujarat plant. So what kind of products are you planning to manufacture in the plant, and what kind of top line are we looking for this? Maximum revenue potential.
Okay, I'll take your first question. So this plant can do oral solids and sterile injectables. So the product portfolio for us is predominantly oral solids, as you know. We have some steriles in the portfolio, which were being manufactured by third parties, which will come into this plant now. And then, the oral solids business that we are used to, that we will continue manufacturing this plant also. As far as maximum turnover potential is concerned, see, the fixed asset turnover in this business is very high. So, for example, our Guwahati facility, the gross block is around 75 crores, and currently we are doing a revenue of around 800 crores from the site, right? So that is all 10x. So that is something that we should definitely be able to do, if not more. So that's why I mentioned that, this plant will hold us in good stead for a long time to come.
And it should also be adding to your margins, because you said that currently you are getting it manufactured from the third party. So if you are manufacturing it in-house, it should also add some 100 or some bits to your EBITDA margin.
It will, but you will not be able to see it in the near term, because, every new facility will have a concept of, capacity utilization building up. So till the capacity utilization of the Gujarat plant builds up to a level where it can, start producing that kind of EBITDA margin, you will be in the transition period. But on a dollar basis, what we found is we are always more efficient in manufacturing in-house than sourcing from third party. So then it will be one.
Okay. And my second question would be, what is the status of Lira and Glargine as of now? Like, I think last update was it was in some large phase of trial or something, liraglutide. So some color on this.
Yeah. So that was a good question. So we got the last patient in for Glargine. Last patient in means 3 more months of data, then putting up things together and then filing. So we still maintain that July, September kind of a period. And Lira, I don't have as good a handle on that. So, I don't know the last patient count in, but, as of now, what we are given to understand that both of them will be hitting in 3 months' time, in a difference of 3 months. So if this is July, then that is October.
So if I understand it correctly, so in another 3 months, we would have all the data and all the things in place, and probably next financial year, we can see the numbers coming in, or?
Yeah. So I'll explain it to you. So we, once the last patient is in, it basically takes 3 months of clinical data, 1 month of putting the reports together, and then the application piece. The application piece, it's difficult to comment, but, generally a couple of months here and there, approval process. So putting all that together, we are looking good for July and August.
Okay, understood.
And we'll be a couple of months behind that. So we'll just add a couple of months. So that's the idea.
Okay. And I think recently this glargine came into NPPA. So would it affect our margins, which we kind of numbered in our books earlier?
Not really.
Okay. And my last question would be, what is current IPM of your MRs? Because I think it's 3 point something.
It's 5 lakh. It's 5 lakh rupees.
Even with the new MR edition?
Yeah. This is post MR edition. This is basically been the case for quarter 2 as well as quarter 3. 5 lakhs.
Okay. And also for this Zaxdy, you said that there were some 20 crores of sales returns. So have we written it off in our books, or are we carrying it as an inventory?
No, we have to write it off. No? We have to take the hit in terms of sales reversal, which is the reason why you see that 9% standalone growth. This is one of the contributing factors.
Okay, that was it from my side. Thank you.
Thank you.
Thank you. We have our next question from the line of Gagan.
Good evening. Thanks.
Audible.
Is this any better?
But it is not very clear.
Can you hear me now?
Please.
Yeah, this is fine. Please go ahead.
Hello. Yeah, am I audible?
Go ahead with your question.
Yeah. So the first question is on the OPEX for the new plant. Can you give us some idea of what the OPEX plus depreciation for the new plant would be in the ballpark?
See, the depreciation would be of the tune of 9 to 10 crores per annum.
Yeah.
On the operating cost estimated, let me come back to you offline.
Any ballpark? I mean, a very rough number would also suffice just to sort of get a handle of what.
Our OPEX at Guwahati is around 20 to 22 crores per annum. So I don't expect it to be fundamentally different. But as I said, this is an order of magnitude number. Don't hold me to it. We'll come back and clarify this to you offline.
Right. And again, you indicated that Guwahati, you have a fixed asset turn of 10. This is a fairly high number when I compare to a whole host of your peers. I understand, that.
No, it is not. And let me, because in the domestic formulations business, the fixed asset turnover is always very high. So if you compare apples to apples, which is a pure DOM form plant, what happens is the asset turnover in a plant that operates to API, US FDA standards, whether it is API or dosage form, there the fixed asset turnover will struggle to exceed 3 to 4. So when you say you're comparing to our peers, you have to take a plant which does only DOM form, and then you will see that the difference does not exist.
Okay. Thanks for that one. And on the debt, how should we think of debt on the books of the company over the next 3 to 5 years?
So we will, after funding the Glenmark acquisition, I think at the end of this financial year, we will be at a net debt to EBITDA ratio of around 0.8 to 0.9. Right? And this is something that, and our strategy has been, in the case of acquisitions, that, we see a good opportunity, we will fund it through debt. And then, since our business is cash generating, because the structure of the business doesn't change, it's still going to be an 80% GC plus business. So we will continue paying down the debt based on the monthly cash flows. So that strategy doesn't change. So this is the first time I think, we have hit a situation where we are close to 1 time debt to EBITDA. So what will it be in the future? If there are no further acquisitions, then we'll pay this down over the course of the next financial year, right? So we will go to zero debt. But then what other things might happen on the inorganic side, that is impossible for me to predict. But I think overall from a debt to EBITDA perspective, we don't think we'll go beyond the 1.5, 2 times mark in any circumstances.
But I mean, as of today, if there are no further acquisitions, you believe that the debt can be paid down in full in the next 12 months? Is that correct?
So at the end of March, we will have around 500 crores of debt. It will be lower than that, but I'm giving you an upper number. Okay. And if I have no acquisitions in FY24, we can pay that down fully.
Okay. Right. And final question on glargine. I mean, the prices of glargine will also, I mean, they probably already have come down. I don't know what's the final notified price, but I think this year glargine came under price control and further prices would have reduced. In such circumstances, with the price of Lantus coming down, how do you foresee the market developing out?
So on the price front, look, if I'm right, then the major hit, because it is 70% market share is with Lantus. So we anyway were planning to sell at a lower price, which happens to be lower than the price which had come in. And that would be a strategy going forward also, to sell it 20 to 30% less than the brand leader. If I look at the current numbers, I feel that, it is the Indian companies which are doing better. If you look at the growth in the last quarter, then we see that the parent, the innovator brand is slowly getting to very low digit of growth. And it is the Indian brands which are picking up. And, there's a lot of history to it. We have seen that, most of the time when Indian companies come up with generics, they tend to take the market share over a period of time. So I don't think there would be something very different this time.
Okay, all right. But given the fact that you plan to price it at whatever 20 to 30% below the innovator themselves would now have to comply with a lower price. So to that extent, your pricing would also have to move down by the additional amount by which the innovator will come down because of the DPCO. Would that impact the economics for you from what you would have originally planned or thought?
No, Gagan. Why? Because we know that to dent this market, and generally once you come out with a generic product, there is a fair expectation to get the prices down. So that was anyway a part of plan. Even if this wouldn't have happened, we would once we get the complete hand on everything, the strategy is to sell at a lower price. And I think that is what is going to happen with most of the companies.
Okay. The final question is on the genericization of the SGLT2s and DPP4s. Would they also in any manner impact the usage of insulin? Would they delay the usage of insulin because now you have affordable and effective newer generation diabetes control oral solid products available?
So, look, I can tell you the global data where all of these products have been available, and even the newer products have been available, which have still not hit the Indian market. We always find that between 10 to 15% of people do need insulin, and that hasn't changed over a long period of time. So what happens is actually somebody who could have got insulin on 40 might get it at 45. There might be a delay. But patients who require insulin are the patients who would be requiring insulin. So the global data doesn't suggest that the insulin sales have gone down. So that's the sum of all.
But you concur with the fact that the onset of the usage of insulin for any given patient it might inevitably be delayed because of better oral solid products available, and therefore to that extent the market growth of insulins might be cannibalized or taken up by the oral solids from these two product lines?
So then a couple of things play together. So what happens? There are some indications which are cleanly for insulin only. Like for example, it's type 1 bachas, it is the GDM, the gestational diabetes mellitus, it is the patient who comes. So it's a play of these 3-4 things. While what you are saying is right, that there has been a delay in insulin, which has been it has happened since the pioglitazone was introduced, so it's not something which is new. But at the same point of time, there's a higher incidence of GDM, there's higher incidence of infections, wherein for short term you need insulin. So, a lot of things play together. And when you do a sum total of all these factors, what comes out is that insulin usage has always been around 8 to 10% of diabetics, and that remains.
Okay. And on dapagliflozin, I think AstraZeneca has received approval for indication expansion to heart failure for dapagliflozin. And from whatever I am able to understand after reading NIH data from US, the outcomes of DAPA for heart failure are actually better than sacubitril. And if that is the case, especially given that there's a large cohort of diabetics who have heart failure as a comorbid condition, do you see the uptick of dapagliflozin actually improving substantially and it actually taking over some market from sacubitril?
So, look, heart failure is a failing ailment. It's a failing heart. So there is no treatment to reverse it. It is just to prevent it where it is. So it will always be more the merrier. Since you are talking hardcore science, then let me tell you, the new heart failure guidelines are now talking about initiation of 5 drugs together. And these two are just 2 of them. There is a beta blocker, there is an ARB, and then there is a spironolactone. So because the ailment is such where the heart is failing, more is merrier. So there's nothing like a replacement. But DAPA has been showing very good results. DAPA HF has now come in. It's been some time. Even sacubitril valsartan has actually, the major change has happened there. Now they were only talking about a ejection fraction which was less than 30. Now they're saying even preserved ejection fraction should be given, sacubitril valsartan. So all put together, this is one, segment which in India will grow very fast. And DAPA and sacubitril valsartan with beta blocker, spironolactone and the sartan, all of them will remain integral. That's what the guidelines says.
Yeah, I understand. I was looking for.
Come back in the queue, sir.
Okay. Thank you. I'll get back to you.
Thank you. We have our next question from the line of Harshal Patil from Mirae Asset Capital Markets. Please go ahead.
Thanks for the opportunity, sir. Just have one question or a clarification required. So sometime back you said that we've got some product launches delayed in FY23 because of some regulatory permissions. So they would be pushed on ahead. So from that perspective, I just wanted to have your qualitative comments on the new launch momentum going into 24, 25, and any qualitative comments from your end would be helpful.
Yeah. So, if I get you right, you are asking that, I commented on delays in the new launches because of regulatory issues, and you want some qualitative answer on that. And what is the pipeline looking for the next 2 years? Am I right?
Correct, sir.
Yeah. So, these delays, they do happen in business, so there's nothing much to dwell into that. The only difference that it makes it hurts the budgeting which you do at the start of the year, and you are aware of some movements. Right. But one thing important which we didn't speak, during the call, and I'm thankful for you for raising this up. From the last 3 months, we have started putting applications from our own R&D. Since now we have put 3 applications. One is gliclazide sitagliptin, which has got approved. We have done the BECT and the phase 3 will start. The second is gliclazide with dapagliflozin, and the third is dapagliflozin with metoprolol. And it's good to tell you that all 3 had been approved in the first SEC meeting itself. In 2, the BECT has already been done. The third one, the BECT, will now happen. We just got the permission a couple of weeks back. So we have around 8 such applications to be moved in this year.
Okay.
Right? So this is over and above what, generally is coming in the market. So look, let's do the probability number. When 1, 2, 3, 4 drugs come out of patent. Then it is like 4 into 3 into 2 into 1. So that's how it multiplies. And then add up the SKUs, it just goes to a different level. So when DAPA came out, Indian companies didn't make DAPA 1. They just, we all combined it with all kinds of products, which are all ethical and which are for the good of the patient. So this newer SKUs and the newer combination will keep on hitting us. Right now, even 24 looks very, very busy on the new product side. And on top of it, we are hopeful that, most of our 8 applications which we are planning to move will get success. Fingers crossed, but I just told you how the record been for the last 3 products. So these things put together, and then, another gliptin is getting out in August. There's something important getting out in September. So all put together, the plate is quite full. So going forward, you would see the new product growth being very, very significant for the market itself. And for some good reasons, it is diabetes which is seeing the maximum numbers of launches compared to any other therapy. And then followed by cardiovascular, just because of the fact that DAPA has been approved in heart failure and sacubitril/valsartan is coming out. So these two things just make it, too many combinations.
Right. Right. Yeah. Thanks a lot, so that answers the question. Thanks a lot.
Thank you. I would now like to hand the conference over to Mr. V. Krishna Kumar for closing comments. Over to you, sir.
Thank you for your participation in the call. To summarize, we've announced the acquisition of 9 dermatology brands with an annual revenue base of around rupees 85 crores from Glenmark for a consideration of rupees 340 crores. This acquisition will give us a deeper presence in medical dermatology and leapfrog our derma covered market rank from number 12 to number 6. The performance of the Oaknet business continues to reinforce our ability to create value through M&A. The business is on track to exceed an EBITDA of rupees 50 crores this financial year, which is 1 full year ahead of our expectation when we went into the deal. We have clear visibility on secular growth in the cardiometabolic segment and our 3 emerging therapies over the next 3 years. We will continue pursuing growth opportunities in these segments through multiple levers, including new products, expansion of doctor coverage, and inorganic expansion. Eris delivered a Q3 consolidated revenue of rupees 423 crores with an EBITDA of rupees 137 crores and a profit after tax of rupees 100 crores. For the 9 months ended December 22, Eris delivered a consolidated revenue of 1,282 crores with an EBITDA of rupees 418 crores and a profit after tax of rupees 313 crores. For the financial year FY23, we expect to deliver a consolidated revenue growth of 25 to 26% and a consolidated EBITDA growth of 14 to 15%. Thank you all and have a good evening.
Thank you. On behalf of Eris Lifesciences Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
The conference is no longer being recorded.